Hello, this is Mike Swanson. I run the website WallStreetWindow.com. I'm also the author of this book, Strategic Stock Trading. And the odds are that you're watching this video because you got an email about it from me by being on my email list. If you're not on the email list, click the link associated with this video. And if you're randomly watching this on YouTube, subscribe to this YouTube channel and click that little bell, and then YouTube will send you an alert the next time I post a video, because there's some really interesting things now happening in the financial markets. The Wall Street Journal on this weekend had a fascinating story about the surge of traders into the market this spring and this summer who are trading for the very first time. The title of the article is "Everyone's a Day Trader Now." Interestingly enough, on the side of the article is another story that is just as important: gold surges to a record. But most of the people that have opened up trading accounts in places such as Robinhood and Etrade and Etrade and so forth have no gold stocks, no gold ETFs or silver ETFs in their portfolio. And the number of people opening these accounts is tremendous. It's on par with what happened in 1999. According to the story, 260,000 people have opened up E-Trade accounts simply in the month of March. The median age of a Robinhood trader, where there's been even more accounts open, millions in fact, since the beginning of the year, is 31 years old. The average account balance that they have is approximately $3,000. 76,300 Twitter accounts are now following Stan the Trading Man. He's a real estate broker who started day trading just a few months ago. And 25% of U.S. stock market trading is now attributable to individual investors on these apps, which is quite a remarkable number. And on one hand, this is an exciting development. It's exciting to see so many people decide to take control of their money and investing for the first time in many cases in their lives. And there's no greater opportunity to make big gains than in the financial markets. I know, because that's where I started out. That's, it's in the 90s. With $15,000, I parlayed that into quite a big stake in just 12 months. And that's what got me going. But I'm worried about a lot of these new people in the market because they all got in early March. This graphic here shows you on the bottom left the number of Robinhood user positions in S&P 500 stocks. There's roughly 5 million in March, and then it surged to close to 15 million. And a lot of that's attributed to a flood of these new traders that people, they lost their job, they got the stimulus checks, they got into the market. But what I'm concerned about is that most of the stocks on Robinhood over time that reach the top 100 list don't do well. I actually opened up a small Robinhood account myself 2 years ago to follow the stocks in the top 100 list. And for example, last year, 2019, Aurora Cannabis, symbol ACB, was the number one owned stock despite the fact that it was in decline all year. And became a absolutely miserable stock to own. It had been a great stock in the years before and then became an awful stock, but the people held as it collapsed. And there are other stocks like that. Simply following the herd on Robinhood is not a good way to trade. In the stocks that so many people flooded into the market in March and April, on Robinhood, no longer are trading well. In particular, airline stocks are not doing well. Many casino stocks are not doing well. And they piled into stocks of companies that are going bankrupt. such as Hertz, and other stocks of companies that have really tough situations going forward and are badly lagging the market, such as Norwegian Cruise Lines, a stock to avoid at all costs, and yet it's on the top 100 list. It does not to be on the, but it's bad. And that's what makes me worry, is that a lot of people are getting into the markets, or have, without real experience to know what is really happening in the markets. So, for example, we have seen or saw a great stock market rally. That rally also attracted people to trading the markets for the first time. Now, stock market rallies tend to have 3 phases to them. The first phase is the initial move off the bottom. That's what happened in March and April, in the first half of May. On that initial move, just about everything goes up. And in fact, the stocks that are the worst tend to go up the most, because they have heavy short positions, and the shorts cover. The stocks have already crashed, and then it doesn't take much for a stock that's $1 to go to $3 or $5 to $10. So the percentage gains off the low, off really awful stocks, can be big, and that's what happened with Norwegian Cruise Lines, the airlines, and so forth. And that helped attract these people into them. That's the first phase. But when that first phase ends, these stocks tend to top out and start to underperform the stock market. And that began to happen in these stocks in the first week of June. And since then, there have been laggard stocks, and frankly, there's stocks that I worry are going to go into decline from now over the next couple months. The second phase, though, of a rally starts to see the leadership shift into a few big cap stock leaders. And that is what happened in June. We saw stocks such as Apple, Amazon, Netflix, Google, Facebook, and so forth, about a dozen, Microsoft, of these big cap tech stocks lead the market, and almost by themselves push up the NASDAQ 100, push up the S&P 500, bust it out. And it became, if you watch CNBC, those segments on CNBC, almost every single hour, at the bottom of the hour, they would talk about these stocks, because a lot of their audience is in them. People seasoned in the markets, those are the stocks they tend to have already been holding. They tend to gravitate into them. Not so much the Hertz's and these stocks, but these bigger stocks. And the third phase of the market, though, of a market rally, happens when most of the stock market as a whole starts to not really do that well, and these leadership stocks almost begin to be the only thing working, and then suddenly they start to peak out, and then you're like the ninth inning of the rally, or at the complete end of it. Well, that process of the leadership stocks peaking out began last week, and that's a troubling sign now for the momentum of the stock market. Look at this chart of Apple. You can see that the trend line for Apple broke last week, much like it did in March. Now, that doesn't mean Apple is going to crash like it did in March, but it means the momentum in this stock is over. That means the trend is now sideways or down. That means that the risks to the upside simply are not worth taking from a trading perspective. If you're someone that's investing in Apple, you bought it a long time ago or at a low price, okay, that's good. But it's not time to buy new shares now. It's not time to, throw your money at this stock. It's time to, frankly, most people should now be cautious on the market. The Robinhood type people, I think this is a time actually for them to step back if you're new to the market, you started getting in with these other millions of people, now is the time not to trade, but because trading conditions are changing, and this is what I'm most concerned about, is so many people got into the market for the first time at the beginning of this rally and having fun, and then it started to become harder for them. Those stocks they're all piling into no longer working, and they don't know what's happening. And what's happening is that that third phase of the rally is happening. Market conditions are changing, and it's time to now adapt to that. That's the important thing for the new trader to realize. That's why I think it's best for them basically to step back and use this time as a time to learn, as a time to learn from the experiences they've been in the past few months, read trading books, go find websites with more information because there's such a limited information on these apps, refine a trading and investing strategy and go forward. Something like the stock market, in trading, it's a learning process, and the best way to learn is engage, stop, learn from what you've done, analyze your results, improve on them, go forward. Now, that doesn't mean sell everything. In fact, we're actually at an exciting time when that third phase of a rally starts to falter. Often what will happen is leadership will shift into other things. Historically, that's been safe havens, such as bonds and also even precious metals. And that's what we saw last week with the price of silver busting through $20, a resistance that's defined the peak of silver prices now for 4 years. It represents the culmination of a stage 1 basing phase and the beginning of a stage 2 bull market. So from an educational standpoint, take 2 things away from this video and apply them going forward. First of all, the best way to beat the market is to be in the sectors, the ETFs, the individual stocks that are already beating the market. A simple concept, but that's the number one way to beat the performance of the stock market averages. And if you're trading or investing, it doesn't matter. That's the goal to have. Secondly, stage analysis is a critical concept in analyzing the market structure, figuring out what has the most upside potential going forward. Where is something at? Are you at a top? Or are you at the start of a new move that's likely to last 3 to 5 years? That's a cyclical bull market. That's a stage 2 market. In my book, Strategic Stock Trading, has an entire chapter breaking that down. It also talks about how I pick out individual stocks. So this book's available on Amazon.com. Just type my name, Michael Swanson, Strategic Stock Trading, and you can find it. And also subscribe to this YouTube channel. You'll get the next video update, and I'll be talking with you later.